guest says that looking at our current market in the early stage of earnings season history could be repeating itself. Ed Keon, Managing Director of QMA, a part of Prudential, joining us live now from Newark, New Jersey. Ed, great to have you back on Bloomberg. So explain this a little bit about history and what it's kind of telling us about today's environment.
Well, in the long run, the most important thing for stocks is earnings. So the market may be worried about credit tightening in China or what's happening in Greece, but really the most important driver are corporate earnings. And I think what we might be seeing is similar to what we saw in the last quarter. That is that you had a peak in stock prices on October 19th. This time around, prices peaked in January 19th, exactly 3 months later. So the market tended to rally going into earnings season in its early stages, and then doubts started to come in, especially on the sustainability of earnings and on sales growth. So we think that probably things will end up breaking to the upside, but it may take a while, just as it did the last time around, and the jury's still out on whether we'll have a robust recovery of both earnings and the economy, or whether things will be a little weaker.
All right, so still safe to say that there's a fair amount of questions. I know one thing, Ed, looking at the research paper, the white paper that you put out at the end of December, you're specifically looking at interest and inflation, interest rates and inflation, and how they kind of fell after 1982. That was after a period of tightening, correct?
Well, that's right. I mean, there was a great tailwind behind stock prices starting in the early 80s. You had lower interest rates and lower inflation, really lasted for almost 20 years. This time around, we don't have that kind of tailwind. Interest rates certainly don't have any place to go that's going to be helpful to us, and inflation is already pretty low. So you don't have that kind of tailwind behind you. That's why you count so much on earnings to get some forward progress from here.
All right, and in terms of the earnings that we've seen so far, do you feel like it's providing that momentum that we need?
Well, earnings relative to expectations look quite good, up more than 10% ahead of forecast, but that's been helped by a weaker dollar at the end of last year.
Right.
And so I think it's the earnings themselves in the last quarter are not important as the indication on the sales and earnings front for what's going to happen in 2010 and 2011. I think that's probably going to be pretty good, but again, we're still not sure how vigorous this recovery will be.
And I love the name that you had on this white paper, turbulent teens ahead. I mean, your point is, I mean, we know teenagers, those years can be tough ones. You're expecting then a fair amount of volatility in the next 10 years here?
That's right. I think that it's going to take us a while to work our way through some of the things we had to do to get out of the crisis we've just lived through. So that big increase in government debt, research by Reinhardt and Rogoff that I know your viewers are very familiar with,
right.
With This Time is Different, suggests that still is as vulnerable to future crises, which may take different forms over time. So I think it's going to be a difficult time, in awareness of risk and trying to control risk and manage risk is going to be more important to investors than trying to maximize returns.
All right. So what would you suggest to investors at this point in terms of strategy?
Well, the way we've been positioning our portfolios for clients, we've been describing as nervously bullish. So we've tended to hang right around our benchmark allocations for stocks or slightly above. And then when stocks have rallied, we've cut back on our stock position. And now that stocks are falling, the odds are we'll probably add to stocks at some point over the next couple of months, as long as the fundamentals remain as good as we think they are.
What do you expect for the S&P? What we're down about 6% since January 19th. I mean, fundamentally, in your view, should stocks be trading lower from here?
No, I think we will trade higher when all is said and done. I think that the economy is recovering and earnings will improve as we go through this year. Again, there's still plenty of things to worry about, and I think most of those things the market is only too well aware of. But my guess is that we're looking at kind of high single-digit rate of returns for stocks over the next several years.
Just got about 30 seconds left here, Ed. I do want to get your thoughts on the President's State of the Union address last night. Anything he said that maybe impacted your market or economic outlook at this point?
Well, I think the most important thing for the economy right now is credit. And anything we can do to try to get credit flowing into the private sector is, to my view, the most important thing. So we want to make sure we don't do things to prevent credit from flowing. And I think that's, to me, is the most important thing I'd like to see out of Washington action to support the free flow of credit.
All right. Do you think we're getting that? Just 5 seconds here.
Well, I mean, it's a mixed picture.
Yeah.
Certainly, there's some things that are hopeful, but there's also some negative signs there as well.
Yeah, no doubt. All right, we'll see how this plays out. Ed, thank you so much. Ed Keon, Managing Director over at QMA. All right.